Hello, class. Welcome. Let's try a review of some practice we did with adjusting entries. You see on your screen right now the assignment that you worked on, the practice that you did with these numbers and an unadjusted trial balance for Benson Enterprises, and then the requirements here, information you needed to make the journal entries. Then we're going to make uh, financial statements. So we're going to do this in Excel. So this is what it's going to look like. The first step that I took was to put each of these numbers that were given to you in their respective columns. So this is your debit column, this is your credit column, and I did so based on their normal balance. So these are a review of normal balances. All your assets are debits except for the accumulated depreciation, and then your liabilities are credits, dividends a debit, revenues are credits, while um, expenses are debits. So that's where you begin. Interest income is a credit. So that's just to make sure that your debit total equals your credit total to start with. So that checks to make sure that we're on balance, and then we can start making our adjusting entries. Uh, and I made these adjusting entries in two columns. You could do this in T accounts. You could do it just writing out journal entries. However you'd like to do that is okay. So if we go back to our actual requirements, supplies were on hand. So that's the first one. If we do them in order, you can do them in any order, doesn't matter. So we know how much supplies are in hand. Um, so it looks like on the trial balance there's only 710. Typically, there's more here than is on hand because we use some. But in this case, what must have happened is that as we bought supplies, they were recorded as an expense, and therefore they've been going down to supplies expense and not increasing the amount of supplies here. So we're going to have to adjust this up to get it to the 1132. So we're going to debit supplies and credit supplies expense for $422. Here's your supplies expense, reducing the supply expense. So going back to our information, whoops, there we go. Insurance policy, pay for 24 months for 5637. So we look at that. We find the 5637 and it's all under expense. So while we learned in Accounting 101 that we typically debit the asset, sometimes in real life what happens is they debit the expense when the prepaid insurance is made. So we're going to have to put some of that back into prepaid, figure out how much has been used. In this case, 3,053, all right, has been used up, and how much needs to go back into the prepaid for the adjustment. So we need a prepaid insurance of 3,053, and we're just going to round. So we need to debit that for 2690. So we figured out that the amount of months left, 13 months, is 3,053 of insurance. So we debited prepaid insurance and credited the insurance expense for the 2690. So again, we're trying to get to what it should be. In this case, it was put under expense. We're going kind of backwards from what we learned in Accounting 101. All right, going back to our requirements, last payment, 3%, and the last payment was made on December 2nd. Sounds like a month of interest needs to be accrued. So we figure out what that interest is. $80 is our calculation on the note payable for 1 month. And then we debit the expense and credit the interest payable. Notice the interest expense was there, but interest payable was not on our trial balance. We just add that at the bottom of our spreadsheet here. Okay, rent was paid for January on December 31st. We want to get our rent in early, so we need to move that. It was recorded as an expense in rent expense. It should be a prepaid. We credit the rent expense. We debit prepaid rent for the 1 month for 360. And then the last adjustment has to do with our employees. Each of them worked 6 days. We have 4 employees that are sales. There we owe them 6 times 100 times 4, 2,400. We owe the office workers 6 times 4 times 80, 1920. So our total payroll liability at the end of the year should be 4320. We have not made any other adjusting entries, so last year's amount of salaries payable is still here, and we need to make it 4320. So we calculated how much we owe the employees since the last time they were paid. We take the difference between what it was from last year and what we want it to be, the 4320, and that gets 1819. We credit that, and then we try to split this between the two expenses because we have office salary expense and sales salary expense. That's not really critical, but that would be typically how it was done in real life. Okay, so that concludes our adjusting entries. So the rest of this is to put this thing together. So we do an adjusted trial balance. We adjust each balance by the amount of the adjusting entries. Then the order we should do our financial statements is income statement. It should look like that. All right. The order of expenses is not critical. All right. Net income at the bottom. Then we go a statement of equity. Let's move it over so you can see that. We have capital stock that didn't change. This is a new business, so there's no retained earnings. Income, and then our dividends. And then our balance sheet. Okay. That, of course, should balance. It's actually off by $1 because of rounding in Excel. But notice this number from retained earnings goes here. Capital stock goes here. So this is related here. This came from our income statement. Remember that how that net income goes to retained earnings. So you can't do your balance sheet complete until you've got your statement of equity. All right. So that's what it should look like. Current, long-term, broken out, classified balance sheet going forward. So that's how you could have done this. Again, there were other ways, but the result should be the same. So that can help you see where you got it correct and what you did incorrect and learn from that.